afternoon. I'm Martin with the Commonwealth Group, and I'm sitting here with our fearless leader, Wes Beibers, President and CEO of the Commonwealth Group. Wes, thanks for driving up to Lexington, Kentucky to join us today. We're going to be talking a little bit about the cost of origination or how much money it takes for a lender to put a loan on the books. Kick us off here. Who are you? What do you do here? And tell us a little bit about the cost of origination.
Well, first of all, thank you for having me. Always a pleasure to come up to Lexington, spend some time up here. Too bad it's not horse racing season. I love to watch the ponies run. At any rate, I'm Wes Beavers. I'm CEO of the Commonwealth Group. We are a fulfillment service company as well as a consulting company for people involved in the mortgage industry, whether they're a bank, credit union, independent mortgage bank, or whatever, anything like that. Uh, I am mentioned that I am the CEO, which technically means that I run the place, I suppose, although I'm not real sure about that some days. I think it runs me more than I run the company. But again, happy to be here. And uh, like I said, you and I have been discussing cost of origination because we had some reports come out relatively recently, and it's up again. It's up again.
Comes up a lot in our business.
It does. I know with you out there working in the field as much as you do, you hear it quite often. But like I said, one of the things that we always talk about when we're brought in on a consulting gig with, again, whether it's a bank, a credit union, or a lender, is we spend a lot of time talking about what does it cost you to put a loan on the books? Simple as that. And the thing about it is that I find a little disturbing, distressing. I'm not sure what the word would be, probably distressing are the number of people who don't know that answer.
Right.
We'll ask people all the time though, we'll say, what does it cost to put it on the books before you sell the loan? And what I mean by that is before any service release premium or servicing value is applied or anything like that. How much did it actually physically cost you to make the loan? And I'm always amazed. People don't know.
Right.
They look at me or they look at us and they're going, "What are you
Why are you
talking?
asking me
Why are
that?
you asking this question?"
I don't know.
I don't know. And the thing about it is that what's so important about that is if you don't know what it costs you to put a loan on the books, then how do you know that your margins are correct?
Hmm.
And that it's one of those things where people say, "Well, I make it up, when I sell the loan." Well, I understand that, but it's important to know what it costs you to put that loan together and what it costs to get it together before you sell it to know that you've got enough margin there to operate your company profitably.
Right. Now, without going into the weeds too much, what are some common factors that would contribute to the cost of origination?
Oh my goodness. Whenever we're called in to do a cost of origination analysis, which is a pretty regular occurrence, um, we get a lot of strange looks because we really get into a lot of stuff. I'm not going to get way out in the weeds here, but the first thing we're going to take a look at is what are you paying your loan officers? Number one. Well, actually, we start with the revenue side. I guess I should start with that. We look at your revenue source exclusive of SRP. And this is going to be things such as are you charging an origination fee? Do you charge an underwriting fee, a processing fee? What are the fees that your company charges? It's going to vary by company. Different companies do different things.
Right.
So what we're going to take a look at is we're going to start with the revenue side. And then we're going to take a look at uh, what are you paying out? And
Yeah.
that's a very simplistic version.
Expenses.
The things that you pay. What is your loan officer compensation? What are you paying your underwriter divided by the number of files they have, for example? Same thing for your processor, your closer, all of the people that are associated with the manufacturing of that loan. We're going to take a look at all of that. We're going to space it out over your production and say, okay, your average cost to put a loan on the books is X,
Right.
whatever that number is. And by the way, it's going to be different for everybody.
Oh, yeah.
It'll be different for everyone. So that's where we start. And it's a great exercise. And the thing is, a lot of times when we do it, we'll have heads of mortgage departments or head of production, whoever it happens to be, go, I had no idea.
It's surprising sometimes.
And it's like you're losing. I mean, it really sounds crazy, but it's true. People will come up with numbers and it's like, okay, it's costing us this amount of money to produce a loan. And by the way, nobody makes money originating.
Hmm.
I hear people say, well, I make money originating. No, you make money when you sell the loan.
Right.
You don't make it when you actually originate the loan. So if you're retaining servicing, you're looking at your servicing value over time. If you're selling at the time of the closing or immediately thereafter, you've got your SRP, your service release premium, that's taking into account. We actually run into deals with people where you look at it and people are shocked at what their margins are, how low they are.
Hmm.
And even though you say, well, that's bad, it's still a good thing because now you know, do you need to adjust your margin?
Exactly.
Do you need to adjust your expenses and that sort of thing? So all of that comes into play when we're figuring cost of
Sure.
origination. And the one thing we always tell people, if you don't know what your number is, you're in trouble.
Right. You better find out
You
quick.
need to find out quick. What is it going to cost you? We run into people who are losing money, and we'll say, "Well, what are you going to do about this?" And they're like, "We're going to make it up on volume." No,
I wish.
no. It just means you're going to go broke faster.
Exactly.
So
So once you figure out what your cost of origination is, could you maybe tell us about some common ways that one might reduce their cost of origination? You kind of touched on
sure,
it briefly there.
there's a couple ways you can do this. One of the ways that you can do it, which we can talk about at a later time, is taking a look at your origination structure, and by that I mean your loan officers, how you pay them. If you look at a commissioned loan officer, typically that's your, you know, most highly compensated person
Hmm.
on an individual file. There are some options that you can do there that you may want to take a look at. That's a conversation for another time.
Sure.
But
Maybe
you
like where the loan app came from.
right, where
Was
did
it
it
from,
come from? And
was
and
it
and
online? Was it in person? Was it one of the more traditional methods used?
exactly,
Yeah.
all of that comes into play. But from the expense side of the equation, one of the things that we look at is we look at how many loans are you doing unit wise.
Mhm.
I'm not talking about dollar wise because your unit cost is going to be determined by the people like your processors, like your underwriters, and that sort of thing. And the thing about it is, when we do that, again, we get a lot of shocked looks
Hmm.
when that happens. So, one of the things that we like to tell people is, have you ever considered contract underwriting or contract
That was
processing?
my next question.
Yeah. And and the thing about it is, if I always say that contract processing, contract underwriting, it's kind of I got to be careful that I don't violate a trademark
Mhm.
here. We all know who does ride sharing.
Sure.
We're very familiar with those companies. But it's kind of the ride share model. You only pay for it when you use it.
Hmm.
Whereas, like, if you have an underwriter on staff, for example, you may have periods of time where there's not enough business going on, and that person is just there and they're drawing a salary.
Yeah. This month would be a perfect example of
This
that for lots of
December
lenders.
is usually a slower month for a lot of people. So once you have that going on, you suddenly realize this is your carry cost.
Sure.
What is your carry cost going to be for that person? So one of the things that we like to tell people is, what is your break even? Now, depending on your cost structure, depending on where you're located in the country, that kind of thing, you can have quite a bit of variation. But in general, in the broadest possible terms here, we generally tell people if you're not actively processing 20 to 25 loans a month, you're losing money.
That's a break even
That's
point.
kind of break even. That's where it sort of breaks even. If you're a lender or again, and when I say lender, I'm meaning banks, credit unions, as well as
Hmm.
mortgage bankers. But if you're any type of lender and you're doing, say, 10 deals in a month, maybe you're a smaller community bank, that sort of thing. That processor that you have there, if you're only doing 10 files a month, chances are pretty good you're losing money
Yeah.
on that. Same thing with an underwriter. If you've got an underwriter on staff and because they are comparatively more expensive than, say, a processor is,
Maybe you the highest paid employee,
right?
operational employee that is.
It's usually your highest paid operational person. So if you look at it that way, what is your carry cost
Sure.
on that person versus just having a fee whenever you do the loan? The break even on an underwriter is about 40.
Hmm.
It's about 40 loans. Now, it's going to vary according to what your cost structure is. It's going to vary, frankly, based on where you're located in the country.
Sure.
There are some places in the country that, let's face it, unit labor costs are more
Yeah.
expensive.
Wages are higher, rent's more expensive.
That sort of thing. So depending on where you are, there's a little bit of wobble in that
Hmm.
number. But if just kind of as a rule of thumb, if you're doing, again, if you're processing less than 25 in a month, you really need to look at contract processing. If you're underwriting less than 40 files in a month, you really need to take a look at contract underwriting
Sure.
because you're again, it's the idea of the rideshare. You're only paying for when you use it.
Hmm.
And so in softer months, like maybe a December, like when we're taping this, then it's going to be easier for you to maintain that. It's kind of that old thing of it's a fixed cost versus a variable cost. Well, you have variable revenues
Right.
as a lender.
Sure.
Some months are better than others. Let's face it, June is going to be better than January. It always is.
Yeah.
So you've got variable revenues. Why do you want to put a fixed cost model on a variable revenue model?
Exactly. Wouldn't it be nice to have variable costs in a lower
Right, your
month, lower
variable
volume month?
right, your variable cost will work with your variable revenue. So, okay,
Sure.
your revenues go up, well, your costs are going to go up. But if your revenues are down, your costs are down. So you're
Exactly.
maintaining profitability.
And that's not to say don't have any, underwriters or processors on staff, but flex in contract help when
Right.
when you need
And
it.
and and sometimes we get people who, for example, we've worked with companies before where they have a processor on,
Sure.
and maybe they're sitting at 35 files. Well, 35 files is more than enough to keep a good processor busy,
Hmm.
but there's not enough there to justify a second
Sure.
processor.
And you don't know how long that's going to
Right.
stay too.
Right. So there's some people who we only work in peak months
Sure.
with them. So they may have a contract in place, but we'll only, their regular processors doing 20, 25 loans a month, and we're picking up the additional 10. So they don't have to, so they don't have to hire for that
Right.
kind of thing.
So, say a lender's discovered what their operational cost is, or maybe say they haven't too, but they have determined that they are going to need some contract help. What would you say sets the Commonwealth Group apart from maybe some other contract services providers out there as far as contract underwriting and processing is concerned? What makes us maybe a choice for
I
lenders?
think there's really two things.
Hmm.
First, hey, we are patriotic Americans. We do everything on shore.
Yeah, that's a big thing.
That's a big thing, and especially if you're a. We seem to notice with banks when we're going through their vendor management process, that's a question that comes up quite a lot. And it's where are you performing your services? Where are your people? And all of our folks are in the good old US of A. And so for a lot of banks in particular, and credit unions for that, it doesn't seem to come up as much on the mortgage banker side. But a lot of times they'll have as part of their policies that anybody who has access to NPI, non-public information, is based on shore.
Hmm.
So that's one thing. Everything here is on shore. We're subject to the laws of the United States. The second thing is a little more, I guess it's more of a claim than anything else, and that is we have the expertise.
Sure.
And what I mean by that, I'll use this example. Many years ago, when I was underwriting full time, I underwrote, like a lot of underwriters, FHA, VA, and conventional underwriting. I did all of them, kind of thing. And for whatever reason, I can remember times when I was underwriting full time where I would be underwriting a lot of conventional files, and then all of a sudden, here's a VA loan.
What's that?
What's that? I haven't done one in a while. I can't remember how to do this. So that's one thing that I always say. We're in it every single day.
Sure.
So we have to keep up with the guideline. We have to be familiar with it. So we have the expertise. Same thing on the processing side. Because the way you process an FHA or VA loan is going to be a little different than the way you process a Fannie Mae loan,
Sure it
or
is.
especially if you're doing a non-QM loan, like a DSCR, for
Hmm.
example. Um, all of those things come into play. But I really think expertise is the one thing because usually it's kind of interesting. We do some work on mitigation work and that sort of thing in another area of the company. And sometimes we'll get people say, "Can you look at this? Can we save this deal? Can we prevent it from repurchase?" And we find a lot of times that the error is just because the underwriter, for example, it's just not something they handle every day. And hey, guidelines change.
They do.
They
Somebody's
change.
got to keep up with them.
Somebody's got to keep up. But we're in it every day.
We
Is
are.
is the point?
Well, I appreciate you spending some time with us
Yeah,
today
it's
and
been
talking about the
great.
cost of
I gotta go.
origination.
I gotta go find some bourbon.
Lucky for you, I know where that is
Oh,
around
I
here.
had a feeling you might.
Well, once again, we're the Commonwealth Group. I'm Martin. This is West.
Hi,
We
everybody.
appreciate you joining us today. And if you couldn't tell, we provide consulting and contract services to mortgage lenders across the U.S.